The three waves technique I'm going to show you today is a powerful trading method that utilizes all three time frames that we look at on a daily basis, the weekly, the 2-day, and the 195-minute chart that helps you identify and track trends as they develop, as they grow, and then as they fade. Now, the key to the three waves technique is to use charts on a single display like you see here and view the Heikin-Ashi candlesticks, the volume, and the trend line simultaneously. By monitoring all three of these time frames, we as traders can identify the inception of a move, watch it grow, detect a fake out, and avoid it or cut our losses short. Now, just to make sure that you understand how this is set up, and at the end of today's video, I'll also have a link on how to set this chart up for yourself. I'm not going to show that in this one. I've done that in another video. But what we have here, Heikin-Ashi candlesticks. And again, remember, Heikin-Ashi candlesticks show you the average pace. They filter out all the noise. The opening on a Heikin-Ashi candlestick is basically the average of the high and the low from the prior candle. The end of the candlestick, either the top if it's moving up or the bottom of the candle if it's going down, not the wicks. But again, the close, that is a combination of the high, low, open, close of that current candlestick. And then of course you have the high during the session and the low of the session on there. So what it helps you do is see what's really going on average with the price. I find it extremely helpful. Once I discovered Heikin-Ashi candlesticks, I got away from all that other stuff that didn't seem to do a lot for me with the high open, low close on a standard candlestick. We have, of course, regular volume here on the bottom, and the volume is typically tagged to the color of the candle, although we do have this set up to where it will change the color if the close is a different color from the prior. So it changes it up a little bit, sometimes not too often. And again, we talk about that in the training attached to this one at the end that tells you how to set this up. We do have this dash along here on each of the time frames is where the price is during the day as you are looking at the charts. Those who know about Heikin-Ashi candlesticks, it can sometimes be confusing to know exactly where the price is as you're looking at that chart, so we make sure it's on there. And of course, we use trend lines. We only set the trend line on the weekly chart. Now you can see, wait a minute, Tom, it's just going from green to red. How are you setting a trend line here? Well, when it just starts to develop a new trend, we actually go to the 2-day to set that up. And then once it develops in full and we have a second candle under the same color, we can switch over to the weekly chart to set the actual trend as we move forward. Now, what I want you to get used to also at the bottom, 195-minute chart, middle, 2-day chart, top, weekly chart. And again, we have these synchronized so that when we go from something like the NASDAQ 100 QQQ here to the S&P, it switches in all three time frames. We show you how to set that up also. Now, what are we looking for? Well, our bread and butter for years and years at Charting Wealth were weekly vertical crossovers. The folks who are Patreon members, you know about them. We give you a list of potential weekly vertical crossovers every single week. It's just one of the benefits that our Patreon members get. Well, you can see as weekly vertical crossovers take place, that is when we go from green to red or red to green. And what's so beautiful about this weekly chart, there are occasional fake outs on the weekly chart. Occasionally you will see a trend starts to develop. It appears like back here on the week beginning May the 31st of 2022, when it looked like we'd reached a bottom, and then boom, things started to move up, and then they rotated back over again, a fake out. Now, it could have looked very much like, as volume had accelerated here, that maybe it had reached a bottom. Volume slowed down, and then when we saw the doji here, there really wasn't a lot of high volume. And then all of a sudden things switched over, and the volume went down even less. Not something that you typically see when things turn around. You would expect the volume to increase like it did when things actually turned around. But again, things will get weird in the market sometimes. Now, learning how volume works. I'll do another training for you on volume so you understand it a little better as to what we're dealing with. But what I want you to get used to as you start analyzing charts for potential practice trades is how accurate are your weekly vertical crossovers or changes. We'll just call change in color. How accurate is that? Does that happen by happenstance, or does it typically work? That means, does it give you some idea that it's about to change? And when it does, do you have enough time to jump in and make a move and then get out with a profit before things flip back around on you? And when they flip, do they flip so hard and fast that you actually just get hammered? Well, the beautiful thing about using the weekly and the 2-day and the 195-minute, or sometimes we refer to it as the half-day chart, so the half-day, 2-day, and weekly, the nice thing about using those all together is you will notice this dashed line here lines up on the weekly, and then if you look down to the 2-day, it's in a different place, but it's lined up to what's happening on the 2-day and the weekly at the same time. And then I'll have to crunch this up a little for you, but if I go back there, can we get, no, we're too far back, but let me move up in time. There you can see on the half-day chart where it lines up. Now, of course, this is representing half days of movement, so the 2-day is 4 times that, right? And how many days are there in a typical trading week? If it's not a shortened week with a holiday, 5 days. And of course, that means there are 10 half days. So there's 10 of these for every week. There's 2.5 of these for every week. And of course, there's 1 for every week on the weekly chart. So what we want to do is we want to pair up. And you notice, we have for years thrown into our setups. We've given you various, whether it was the price percent oscillator, we originally started with the MACD, the moving average convergence divergence indicator. More recently, we switched over to the STC, which is a combination of the MACD and stochastics. But I got tired of simply waiting for some kind of formula to finally switch over. And again, most of the time you're dealing what? Trend following. So when many times by the time the indicator indicates get into a move, it's too late. As opposed to this chart where you're watching the volume as it happens, okay? You get to see how excited the traders are, how much they are trading on each of these time frames, along with what's happening with the Heikin-Ashi candlesticks. And many times, when the markets are flowing correctly, when everything's going in the right direction, you can watch capitulation occur with the volume and with the price. Let's go as to what we saw happen recently on the NASDAQ 100. You had what is, again, market moved down, hit a bottom, rotated over, went from, a down red candle, gotten significantly weaker. You can see where it bottomed out right here, and then the next week flipped over going up. We can see on the 2-day where that occurred, where price came down. You can see these 2 dojis here, particularly this last market capitulation doji with average volume. That's what this line is here. And the volume again staying about the same on those 2 dojis, and then all of a sudden flipped over, and you can see how the volume stayed steady. moving actually higher with a bigger candle, and then moving up to the top. And then guess what? Those telltale doji signs again, where you have the average of the prior candle and then the average of the latest candle. Well, I'm sorry, the latest price moves. So the average of the low and the open and the close on the prior candle, and the average of the open, high, low, close on the current candle being virtually the same, showing you that relative price movement has just stopped. And you can see the volume staying up there, which tells us what? Well, when we see that, we realize price isn't moving. But what's happening is a lot of the stock is selling. And what's happening is the insiders, that's what this clearly tells you, are selling. Because you would think if the volume's going way up and it's healthy, you should see an up move in price. But you can see where it peaked here, and then the volume stayed up. And even when nothing is happening with price, the volume is at average levels. And then all of a sudden, it rolls over, spikes, and keeps moving down. Now, what is that telling you? Well, that's telling you, and you can see it here on the weekly chart too, where you have above average volume, average volume, average volume, and then it moves over into the red. It's telling you the insiders are selling out their stocks of this ETF, what they own, to the people that think it's going to keep going up. And then what happens? It starts to roll over and go down. And you might say, could this be a fake out right here? Well, I'm telling you this as we're looking at it. I'm saying, hey, we have the 30 EMA, that's the exponential moving average. That could be a bit of a floor. Things could bounce off that. But how much has it done that in the past? Let's look at this candle pattern here. If we look at, and I'll blow this up for you, on the weekly chart, we see we have a red down candle with a wick on the bottom. Now, if we go back in time, where do we see another one? Oh, right here at the beginning of this down move. Now, we see one here at the end of a down move. But when we see one at the beginning, okay, that worked. Do we have another one? Yeah, that worked. Do we have another one? That was after a spinning top. Yeah, here's another one after a doji. Here's another one. So here's one that didn't work. Here's one where it started to move down. Then we had a doji, well, we had a spinning top the next week with high volume, and then it spiked back up again. So we could have this situation. That is possible. But again, you had a relatively short down move, a relatively short up move, what we'd call a pullback, and then things took off again going up. Is that possible where we are now as we move all the way up in time? Yeah, that is possible, and we'll be ready in case that occurs. The volume's still decent, and we'll see how this week starts off. Now let's go back, put things back into perspective. We will have the ability, of course, now that we've started drawing a trend line, to see if indeed things keep moving down this trend line. Like if we go back to the prior trend line, and I show you how we had it set, of course, when we first jumped into this latest move, the trend line was here. Now, look at what price tended to do over the course of this trend line. It stayed above it. This was an uptrend line. Remember, we draw trend lines bottom up, top down. Means if it's going down, you draw the trend line from the top, like up here. If it's going up, like we see here, you draw it from the bottom going up. So we see that price tended to stay above. Now, we adjust that trend line as we move forward in time. We like to connect 3 candles if we can. That's a good one. That connects 3 candles. Look as we go farther in time what we see happen. We see as things continue to extend up, and we see that the trend line, we start seeing, more and more breaking of it as we move further up in time. And of course, this latest one, no matter how you draw it, The minute this candle started being drawn, it broke it. You can see where it broke it there starting on the Friday candle, the 2-day candle starting Friday. And of course, it went from Friday to Tuesday because the markets were closed this Monday for President's Day. And you can see how there was no getting around the fact that the trend line was broken. Good trend lines will be that way. When they are broken, it's clear to see. That is why we want to use trend lines. And you might say, well, Thom, how do you determine, like, can this work on every single stock, every single ETF? No. There's some ETFs and some stocks that are just not trackable. I can't tell you exactly why, but there's some when you go back in time, there's just too much noise. Even the Heiken Ashi candlesticks can't help you. It gets too noisy. You can't find trends that give you enough time to jump in and jump out. Now, I will tell you what I do when I look at getting into a trade as I see the market changing, as I see a bottom occur and we go from red to green at the beginning of the next week. What do I do when I get ready to get in? Well, I'm looking again at the prior candles, like particularly when I can see very clearly that a bottom's occurring. We have not much price movement. We have an anomaly here, but volume spiking up. And I'm saying, wow, because think about it. When people are buying stocks, you expect volume to sort of be relative to the change in price. I mean, if price is really spiking up, you would expect volume to spike up. But when price stays high, when volume stays high, when price settles out, either top or bottom, it's telling you there's an anomaly here. Something's happening. People are getting rid of stocks because they know the bottom has hit here. And the dummies are, again, expecting it to keep going down. They're continuing to dump their stocks as people are buying it, getting ready for it to go up. And of course, here, the smart people are selling it as they're expecting it to go down. These are called insiders, market makers, any number of things. You might say, Thom, there are people in the stock market that are taking advantage of other people. Yeah, there are. That happens all the time. You can see it right here. I mean, is it not clear? I mean, again, lots of volume and no change in price. What's happening? People are selling to people who think it's going to keep going up. And again, that is what the smart money does. So why not follow the smart money? That's what we're talking about. So when you start seeing these things occur and you decide to enter into a practice trade going up or going down, and don't forget on something like QQQ, you can look at an inverse fund like PSQ, which is the single inverse of the NASDAQ 100. And of course, it goes up as the NASDAQ 100 goes down. It's sort of like what a put option does. Well, again, you can mess around with these things and practice trade them. Doesn't cost you a penny to try that. But I would encourage you, as you watch these things occur, go ahead, start putting a trend line in. Go ahead and start looking for the ability to jump into these markets when you start seeing bottoms occur, price movement going up, tops occur, price movement going down. You can see this on the 2-day chart. You can see it on the half-day chart. And the trigger for me is the weekly chart. When there's enough down movement that it turns the weekly chart from one color candle to the next color candle, and it's discernible that this is happening, how this is happening, why this is happening, volume backs up what I see on the candles, I then pull the trigger and jump into the move. I might not jump in on a Monday, but I might jump on it on a Tuesday or a Wednesday or even later in the week, depending on what I've learned from practice trading that stock or ETF over time. And you might say, well, is there no hard and fast rule? No, my friends, there is no hard and fast rule. That is why a computer doesn't do this. That is why the engineers that are listening to the show are not billionaires. It is because you can't write a formula. I mean, you are dealing with literally millions of people making decisions, computers making decisions, institutional trading houses making decisions, trigger points, quants, dark pools, you name it. It's all out there trying to mask and confuse you. So what you have to do, as I encourage you to do, is each and every day, 10 to 15 minutes, follow these stock charts. Learn how to read volume. Learn how to read the Heikin-Ashi candlesticks. Understand that price change should make sense to you. Sometimes it doesn't. And guess what happens when it doesn't? This is the beautiful thing for those of you who've taken our training on the average true range. You know that we go over here to this little price and prediction tools, and we choose either a long position or a short position, and we set that based upon average true range. Now, I'll tell you what I do on this chart. I have the average true range set up on the 2-day chart. It's not on the weekly, and it's not on the half-day. I use the average true range to set my loss band and my profit band, and here's what I do. If I go in and I buy 100,000 shares of, we'll say, on this change here, during this week, if I went in back on the week beginning the 9th of January, where I believe market capitulation has occurred, things are changing over, and I decide that I'm going to jump in at some point during this week, and I'm going to buy $100,000 worth of QQQ. I set my loss band, okay, at one time average true range right here on the 2-day chart at the time point that I am jumping in during this week. If you look over there, and if I move the cursor here, I'm going to have to go back, but keep watching right here at ATR. I'm going to take the cursor over to that week beginning the 9th of January. You see it says $11.02. That is where I would set my average true range. Let me show you that. If I go over here to the tools, I go to a long position, which is what this is. I go ahead and pop in the little widget here, and I then go to set it. Now, I told you it was, let's make sure it's 11:03. I'll go here to settings, and this is the entry price. We'll just say it's 281.22, and I'm going to put in 11. I think it was 11:08, right? So that's the ticks right there. I'm going to put the same number of ticks here. I'm going to tell you why. I usually say a 2-to-1 risk to reward ratio. I do it a little different here. So what I do is I go ahead and set my band here. Let's see if you can see it. Yes, you can. Okay, you can see it here. Why are there two here? Did I have another one already set? Well, we'll just look at this one. So what you see here is I've set it so I'm willing to take a 3.94% loss, and I want a 3.94% gain. But here's what I do. I jump in, I set my profit and loss bands at 1 ATR, and then if things go against me, I'm going to limit my losses to 3.94%. But if they go the right way, I'm not going to sell my entire position at 3.94% up. I'm simply going to sell half of it, maybe a third of it, but usually a half. I sell a half, and I cash out there. And then I let the rest of it ride. I let it ride how long? Until as I monitor things and notice, hey, look, I can see where price spiked here, and then afterwards, nothing is happening and it's deteriorating. Hopefully, right in here, the 6 days I have in here, I would be convinced to take my profits and cash out at another 2-3% up where I let my profits ride on the other half of my trade. That's just another way to take advantage of things going in your direction, locking in some profit. And then, of course, if I stayed in too longs and things turned around, guess what? I would have lost any potential profit on that other half, but I clearly would have cashed out here during this week before I lost a penny because the week closed right there at where I had been before. So I made 3.94% on half my trade and lost nothing on the other. Is that not a winning way to go? That is, you minimize your potential for losses, maximize your potential for gains. Now, you might say, Tom, why wouldn't you do the ATR on the weekly chart? Well, because I want to find some way that I can expect me to hit an area of profitability where I can grab a chunk out of the middle and not take too much risk. Could I have jumped in here and used the average true range of the weekly chart? It would have been a lot higher figure, and I may very well have not hit that. So I chose to use the 2-day average true range. Remember, it's just an average of what the ranging of the prices were. So the likelihood of hitting that, particularly on the weekly chart with a good entry point, is quite high. So again, just more food for thought. Things you can try. You don't have to do any of this. What's it costing you? Nothing. So give it a try. You're not using real money. You're just experimenting. You're having fun. I mean, I love this stuff. I absolutely love this stuff. And the market can be vicious if you are not careful. And anybody who's traded for any period of time will tell you, it is your losses that kill you. Letting your wins, letting your profits run is the key. Cutting your losses is the number one thing you have to do. Tell me what you think about these charts. I really love them. Ultra simple. They require, again, a bit of a different mindset. You're not counting on an indicator. You are watching the Heikin-Ashi candlesticks and the volume and following your trend. I think as you go forward in time, if you experiment with this and stick with it, you will hopefully find lots of success. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters. Patreon members, thank you for all your support. If you appreciate what we do, be a Patreon member. We have lots more to share with you.